And okay, so now let's talk about managing a face-to-face audit. Let's go on here now, and now that we've got the basics out of the way, let's look at the specifics here of managing a face-to-face audit. The first thing that starts an audit is the notice from the tax from the IRS saying you've been selected for audit. And as I said, I got one of those in front of me today. Very propitious timing here for this particular audit notice. And this is a letter in this particular situation. The IRS has selected the car and truck expenses, the Schedule C interest expenses, and legal and professional fees. So we're going to look at the years in question. We're going to determine the issues. We know from this notice that I got, it's tax year 2015. And those are the three issues that are in question. The IRS also included what they call an IDR, an information document request. The information document request tells you what specific items the IRS is looking for. And in this case, they want proof of the car and truck expenses, proof of the business purpose, that sort of thing. And so what I'm going to do now is I'm going to sit down with my client. I'm going to make sure I get a copy of the tax return. I'm going to review that tax return very carefully. I'm going to see exactly what claims were put on the tax return. Then I'm going to work with my client to organize the records so we can prove exactly, to the auditor, the numbers that were put on that tax return. And so what I'm going to do is I'm going to match the records that the client gives me to the deductions that were claimed on the tax return. Now, here's the thing that we find in a lot of audits, and that is the taxpayer has more documents to support greater deductions than were claimed on the tax return. And if that's the case, don't ever be afraid to submit additional documentation to actually increase the deduction the taxpayer is allowed to claim, because just because they didn't claim it doesn't mean they can't claim it. And as long as the statute of limitations is open, we'll talk about that in just a minute here, as long as the statute of limitations is open, they have to let you claim those additional deductions. And in fact, and you've probably heard this as a tax pro over the years, you probably heard it, people have told me hundreds of times, Dan, I don't ever claim all the deductions I'm entitled to claim, just in case I get audited, specifically so I can go in there and present additional things to the IRS. Well, I don't think that's a good strategy because it really just costs you money, but the fact of the matter is you got to inquire of your client whether they've got proof of additional items that were not claimed on the return, because you've got every right to claim those things. Now let's go on and talk about ground rules. When we're talking about a face-to-face audit, it is very important to set ground rules with the tax examiner so that the audit does not spin out of control. All right, the first thing I do is if the tax year in question has not been identified, and this is very common that they'll make an initial request for a meeting and not tell you what the tax year is or what the issues are that are in question. You got to make sure that the agent identifies the issues that are in question if there's any doubt whatsoever. As I said on the letter that I just received, they clearly identified the three issues as car and truck, Schedule C interest, and legal and professional, so it's easy for me to understand what the issues are, but they don't always do that. Often they will just say, we want you to make an appointment, and then we're going to look at these various aspects. Don't do that. Get them to pin down the issues so you understand what you're up against. All right, next thing is determine whether you're going to in fact have a face-to-face meeting. The IRS conducts, as we already said, the vast majority of their audits are done through the correspondence process. And frankly, my process, the procedure that I follow in my office here, is to turn every single audit into a correspondence audit if that's possible. Correspondence audits are much better. You can you've got the significantly less likelihood for miscommunication and misunderstanding because you're putting everything in writing. You're providing the documents to them, which are clear and sharp photocopies. You're not leaving any original documents in the hands of the auditor. That's very important. Sometimes the IRS will push for a face-to-face examination or a face-to-face meeting with the taxpayer. We'll talk about that as we go on here. But the fact of the matter is you have every right to have a correspondence examination. You do not have a legal obligation to sit down face-to-face with a tax examiner in person. So keep that in mind. The other thing is do not be pushed into a conference if you're not ready for a conference. These letters that they send out setting an appointment will give you a date that you have to respond by. They'll tell you when they want to meet with you. They'll give you that that deadline, and they'll say, well, you got to be in our office in 10 days or 2 weeks or whatever. Don't be pushed into a conference that you're not ready for. The law gives you the right, and it's Code Section 7605 that I've got cited right there in your outline. The law gives you a right to determine the time and place of the examination, and the law provides that the time and place has to be reasonable under the circumstances. All right, and it's not reasonable if they're not giving you a sufficient amount of time to get organized and to get the documents you need and to understand the issues and so forth. So don't be pushed into a conference you're not ready for. We'll talk about what to do about that a little later on. The other thing is the client has an absolute right to counsel, and this is very important. This finds itself in two particular places in the Internal Revenue Code, not the least of which is the Taxpayer Bill of Rights, which is in Section 7803, and that says that the client has the right to counsel, the absolute right to counsel. And this is important when the IRS is pushing for a face-to-face examination and a face-to-face discussion, a personal one-on-one discussion with the client. I don't ever let the IRS auditors talk to my clients. The idea of having counsel is to provide some insulation so the taxpayers don't say stupid things or things that they are unsure of or speculate or guess or misremember, which is which is very, very likely in a situation of a typical audit. Here, this audit that I've got in question right now, here we are, June of 2018, they're auditing tax year 2015. So these are events that took place 3 years ago. And obviously people don't always remember every little detail. So it is important to provide some protection for your client in that respect. So let's move on here now. Let's talk about the assessment statute expiration date, because it is very critical to understand what the assessment statute is and how that works, because you would be surprised how many times the IRS tries to audit tax returns for tax years that have expired, or the IRS is proceeding in a manner based on an assumption of one kind or another that just isn't applicable in this situation. So let's talk about the assessment statute, the so-called ASED, and the general rule is that the IRS is 3 years from the date of filing the return in which to assess the tax. All right, that's the limitation. 3 years from the date of filing the tax return. Now, of course, if returns are filed late, then that's what the 3-year clock starts with, the date of filing, not the due date of the return. And so it starts with the date the return is filed. And so that 3-year rule is hard and fast, except in these limited situations. It goes from 3 years to 6 years if more than 25% of gross income is omitted from the tax return, and or more than $5,000 of income from offshore activity is omitted. In that situation, the examination goes from 3 years to 6 years. Now, there are circumstances in which there is no statute of limitations whatsoever. All right, and we need to understand that as well, because you'll see this often in areas where the IRS is moved beyond the 3-year rule. They'll try to assert one of these circumstances in which the statute does not apply. First of all, there's no statute of limitations if the tax is attributable to fraud. All right, fraud is defined as a deliberate attempt on the part of the taxpayer to evade or defeat the payment of taxes by any means. We're going to talk about fraud in a little bit because there's a burden of proof in there that's important. If no return is filed, the IRS can go back 3 years, 5 years, 10, 20 years to collect a delinquent, to chase a delinquent tax return, because the law provides for no statute of limitations in the case of an unfiled tax return. And then the next area is that if information required by Section 6501C8 is not provided, then there's no statute of limitations. Now, 6501C8 is the provision of the code that requires taxpayers with certain offshore assets to file that Form 8938. Form 8938 is the statement of certain offshore assets. And if that is not filed and the taxpayer does in fact have offshore assets, then there's no statute of limitations. The IRS can go back indefinitely, and this exclusion applies to every aspect of the tax return, not just the offshore income. All right, so it's important for clients to understand that they've got to file that form, or they are putting themselves into a position where the IRS will have no restriction on their ability to go back and audit. Now, Section 6501C8 has a reasonable cause provision. And what it means very simply is if the taxpayer can prove that the failure to report the offshore assets was due to reasonable cause and not willful neglect, then Only the omitted item is subject to audit indefinitely, not the entire tax return. So that's important. Now, the statute of limitations can be extended by agreement. All right, the IRS and the taxpayer can enter into an agreement on Form 872, which is a consent to extend the time to assess the tax. When the IRS is conducting an audit and the time is running out on the audit, they will ask the client to waive the assessment statute when the IRS has fewer than 6 months left to close out the case. And we're going to talk about that in a little while too, because you need to know how that works as well.